Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook and your host for about the next 25 minutes here on Options Guide TV. So let's start off where we left off. Costco announced earnings. Missed on sales, I guess, is the biggest miss as far as their earnings were concerned. A little bit of concern. Tariffs got mentioned after in the conference call. And so right now we see Costco down about $6.46. We did lean into it, but the stock did bounce a little bit on Friday. And what I mean is we started on Costco. Costco announced on a Thursday. So we had a Friday expiration, and that meant that we could do a very simple skip strike butterfly for a net credit. That trade worked out fine because the market went down. So that expired worthless was able to keep the credit, which wasn't that much. We were trying for 40 cents. If you worked it a little bit during the show, I think it was trading for around 30 cents. But bottom line is for every $1,000 of risk that you had on, you could make 40 cents on it, but you had the potential to make more if the market went up. Now, so we came back and said, well, there's still some sticky volatility, and let's go out and lean into the bear side of things, and let's do a bear put butterfly. And depending on when you got out, if you panicked, which you should do, some panic is good, right? And you got out about halfway through the day, the market did actually bounce a little bit, but then gave it all back. And now it's leaning to the downside even more. And if I go look at the trade on Costco, let's run to the Tradier Pro software. Right now we're seeing vols down around 20%. So I wanted to set up the trade just to show like what a 4-day, the cost of it to put on a 4-day trade versus just the Friday trade we did it at 11 o'clock, Eastern time on Friday. So if you come in and what we did was 7.5 points wide, we buy this, we sell 2 of these, and then we buy 1 of these. That's $3, right? We were able to do that trade on Friday with 1 day remaining for $3.60. So obviously the difference, my moral to the story is the decrease in implied volatility is large. And the fact that it's came down to around 20 here, I still don't mind this trade. This is a solid trade going to the downside. Like if you look at the chart of Costco, just starting from this precipice, from the all-time high there, it is definitely in a downward trend. We had all, crossed over. This is a 20-day going over to 50-day isn't that big of a deal, but then we came all the way down and the 50-day went over the 200-day. Now this is a weakening market. This high is not as high as this high, or this high is higher than this high. And then the same thing that we have down on the downside. So this was a breakdown right here. And if we zoom out, you can see that in Costco basically right in this range. Let me go back and let's grab this area. So we definitely had a breakdown in the chart at the 924 level. Now we're at 909. We're down $6 on it. The next stopping point, or just from doing very quick trend lines, is you see the bottom of these candles right here at 848. So it's going to consolidate a little bit. I expect a little bit of choppiness, but if it closes below 923 today, I think the bearishness continues in Costco. That's simple. So if we want to step up in Costco, you can do one of two things right here. You could just buy a put outright, and that's mainly because vols have came in so much. Looking at about 20% vol, it's trading right about where the historical volatility is at. But the problem is that it's an expensive underlying. So the option contracts are going to be expensive. You'd want to go out at least 32 days. Look at the end of October. I've been targeting this Halloween expiration on a lot of things, but you're talking $2,000 just to buy an at-the-money option contract, and that makes it tough. So the other way that you can approach it is go a little bit shorter. If I was buying one, I would look to go out at least 30 days. I'd rather do a 15-day trade on a long put option, and start with 32 days, right? So if I plan on holding this for the next couple of weeks to see if this chart pattern plays out, I would rather buy a 32-day option and sell it 15 days later. So you know that you're going to get out at a point in time, but you get a decent range of time decay on it, and you're not dealing with buying a 15-day option and getting out when it gets to zero. If you're wrong, on your forecast, but that's the way that I would approach it, especially if I'm buying options. I'd like to err to the side of buying too much time, and then if that also creates an issue if the market just goes against you in general. But that's the way I always approach long options, and we don't do that many on the show. We really don't. So another way that we can look at it too is we could sell in a short call spread, and that's not a bad trade right here, because if we look at the chart once again, the area that we're saying of the resistance is right around 925. So we could sell something close to that. And we'll look at that as an alternative too. Okay, so 910 is where the market is at. 925, we're still getting $15 for 30 days, even though it's only at 20 vol, which is normal volatility for this underlying. We could sell this option contract. I think it might lean into the, well, let's look at this one. I'm going to start here. Close this out. 925, that's right where that area is. And then we got to go fairly wide because these options are just so expensive. So we'll go 20 points wide, bringing that in. Yeah, that's not bad. That's not bad. Risk reward. I thought I cleared you out. 1 second. There we go. 925 hit the bid. 945, 20 points wide, hit the ask. That is a 28 delta. That is not correct. It's not $16. Come on. I need my computer to move. It's back to where we're at. I'm on the right internet. We're selling this one for $15. So this isn't a $16 net credit. We're selling this. We're buying that. That needs to update. I'll just do the quick math. 1585 minus 915, 670 on a 20-point wide. Well, divided by 20. Yeah. So you're bringing in about a third of the width between the strikes, and you're 15 points out of the money. I don't mind this trade at all. Let's go and put it back in, see if it will update for us. I think this is the way I would play it. 16 and 45 a buy. There we go. So 665 is the net credit on a 20-point wide butterfly. You're bringing your 15 points out of the money, and you're bringing in a third, which is $6.65 of the 20-point wide strike. And that gives you a solid risk reward too. So you're 20 points minus 665 is 1335. The reward is 665. Yeah, not bad at all. You're looking at 0.49 on the risk reward, decent width between the strikes. I like this trade. So this is one where you're sitting there, you're looking at it, and your gut is man, vols came way down after the earnings. Maybe I should just buy a put. But then you just think that, well, the fact that Costco is a $900 underlying, that put's going to be expensive just to buy one. So if we look at the valuation as far as, and this has everything to do with the volatility skew, with where vols are at, where what you're selling versus what you're buying. There really isn't that much skew between where you're selling this one and where you're buying this one, which some is usually, well, there could be a lot bigger skew in a lot of the other underlying. So because of that, this is a very interesting spread to do going out the next 32 days. Let's do it. Let's make it the official paper trade. We'll watch this going forward. All right. So we're looking to go out to the October 31st expiration. We're going to sell the 925 strike call and at the same time buy the 945 strike call. Doing this for a net credit, we'll call it $6.70. Make the math a little easier for you. What's that? 85. I guess we could, let's leave it there. 670. I know we could get filled there, or I feel like we could get filled there. I don't know, of course. And that will be our paper trade. This will be a longer term trade on Costco. Now, gold, we've done a lot on, and oh my gosh, gold is the two underlyings that we've been looking at, that we've been trading. It's up again, 1.5%. And it's just interesting. Maybe that has a lot to do with the inflationary numbers that came out on Friday that are saying inflation's being a little bit sticky, implying that we're still got the tariff talk raising inflation, but the Fed, in general, the consensus is that it might just be a one-time hit, and that inflation going at the beginning of next year will start to creep back down. I don't know, because there's some people that don't believe it because they keep buying gold and they keep worried about the recession. But the markets keep trudging forward and we keep getting new highs in the market. The NASDAQ is back up again today. The Russell 2000 index is the only one that's kind of struggling a little bit. IWM, and IWM, we did our bearish trade, and I know a few of you out there have jumped in the risk graph. Oh, okay. I'm happy to do that. I'm sorry, Beck. Go ahead and put that up for Beck on the Costco trade. So this is called a short call spread. And with the short call spread, I'll go through it a little bit. See, sometimes you assume, and you shouldn't assume. But here's where the market is at, 909. The risk does not kick in until about 925. Then you have risk all the way up to the other strike, which is the 945 strike. And that's where the max risk kicks in. But this looks like the profit and loss graph, the green line right here, looks to be a pretty accurate line. And this is on I guess I can make this a lesson too. On a consistent basis, if you are doing trades and you're doing what I mentioned in that, you're trading something that's 30 days out, the time premium in your long option contract helps offset the risk to start. So if the market goes down and you put this on, the green line is your profit and loss graph while time is decaying, right? So this is as of today with 30 days remaining. But if it goes down, you get rewarded fairly quick. But if it goes back up, you're going to lose, but it doesn't hurt as bad, right? Look at how much difference there is between here and here. And I guess that's why I had the conversation about the amount of premium that we receive. I prefer to sell a spread closer to where the stock is at and have a better risk reward profile in case you're wrong, right? In case the market goes against you. And if you sell a 30-day trade, we're going to know fairly quickly if, like today, as a matter of fact, if we stay below that range on that chart, we're in new territory, right? We're hanging out in, look at that gap down. Like we're hanging out in new territory here. It's trying to figure out where it wants to go to next. Does it want to come back and challenge this range in this area, or is it going to go back to the next stopping point down here? And so we'll know fairly quickly. And if it comes back to this range in the 925 range, then our protection is the fact that we were able to sell this for $6 and that we have a decent amount of premium in our 945 option contract. So if this goes against us to start, that 945 is going to be an expensive option contract. It's going to be an at the money option contract, and it will give us some protection. That's the rationale behind doing a short call spread, positioning it closer to where the underlying stock is at, and going out a little bit further in time. As a matter of fact, a lot of times, if this wasn't such an expensive underlying, would look at going out 45 days to put on this trade and then closing that out 20 days later. We're going to look at this one, doing this one for 30 days, closing it out 15 days later, thereabout. All right. Any other questions? No, we're good. So gold, I mean, I don't mind going back to the well again on gold. When it's Monday, it trades all over the weekends. So you had this as a gap up in gold in the chart. Let's look at the Friday expiration, and we're going to be getting into October, everybody, here it comes. So Friday the 3rd is the next expiration, and then they got the weekend. Is this just noise? I don't know. I know I definitely want to do something neutral to bullish on this, on gold. A little frothy. We're getting up extended quite a bit from the 200-day. I think we could target something down around the 343 area. All right, let's look at gosh, I feel like I got to lean bearish on this. Yeah, let's do it. Let's lean bearish. I mean, it's tough because it's a juggernaut right now, but I think the path of least resistance is going to be back down to this range. That's a fairly decent swing. So I think we're going to buy the 350, sell the 345, something like that. And we're going to do it on the put side. We'll do the 350. We'll sell the 350. We'll buy I think we usually did 7 points. Okay, so let's make it simple. Let's do the 357, sell 2 of the 350s, and then we'll try 3 points. Let's try this one. We got to get it done for 4. That only leaves us $1. It only leaves us 80 cents if we're correct on or if the market goes down. I'm going to load that one in the what if calculator. So the total cost is $3.19. Don't mind that. But if we go down, we're only going to make 81 cents on the trade. If we go to this range, we'd want it to stay more within the strikes, more within the range. Market is right here at 350, 382. 350 is where we need the market to go down to. We're paying $3.19 for it. I don't mind that price at all, but we do need the market to drift, and then it would have to go down. Right now, we're up $5. So we need a 1.5% move to the downside over the week. I just don't like the fact that this is going to be trading for 4. And so the maximum you make is 80 cents on the downside. So we might have to pay a little bit more. If we move this over, let's go up one more strike, then that's going to be 25 cents. We're going to have to pay 25 cents more. So 357, let's pull it up to 358. 385, and then we'd make $1.15. Yeah, that's a little bit more enticing. It says 112. Your eyes would be focused over here based off of where it came in at, where the profit and loss calculator grabbed it. I don't know. I mean, is it worth 25 cents more to have to pay 380 versus 3? Maybe I think I'm gonna say we're gonna give up the profitability, because that's quite a big move just to the downside anyways. Let's do this one. This will be the official paper trade for the week in gold. Still like gold a lot. I just really like trading the underlying, and some volatility, some predictability. So there you go. We're going to lean bearish on gold this week, and we're going to push it to the downside. We're looking at buying the 357 strike put, selling the 350 strike put, going into October 10-3. So we are in October, scary month, right? And then sell the 47. We're going to do this, send that to ticket for around $3. $3.15 for $3.15, $315 per 1x2x1 open wing butterfly. All right, and I'll pull this down, give you a little bit better picture of it, and away we go. Okay, next, I was looking at Starbucks. I don't think we officially said we'd get out of that trade, but we did a 45-day short call spread in Starbucks. And let's look at the chart. And it was right around the 85 level. It hasn't really done much. So time decay is your friend on it. But 45 days went out about 30 days ago. Let me grab from right about here. Right. So once again, this high is lower. This high is lower than this high. This low is lower than this low is lower than this low. It's bounced back. It's hanging right around in here. If you had the trade still on, or if you did it, I would look to get out of it. We are showing a little bit of I guess a little bit of strength right here. Today it's up 193 or 2.3%, and we're trading above the 20-day moving average. And I think we sold it right around 85. I was looking for it. I couldn't find the trade. Just thought I'd mention that. I'd get out of the trade. I don't know if we sold it around 85 or if it was up here around the 90 level that we sold it. Okay, what's another trade that we're thinking about doing? Oh, UNH. UNH is still a very interesting trade. 33% implied volatility. Earnings are coming out at the end of October 31st. So you'd look at doing the 25-day, writing that into earnings. 25-day, 34 vol. And if we pull up the chart on UNH, we still have that gap to fill, right? So the gap starts right there. I kind of grabbed a little bit. I don't know if I can't pull that down. Right there, 376 is where it's at. And we're just hanging out right at the top of this candle, right at 342, 344, right in that range. 361, then you're looking to run up to about 375, from 361 to 375. Strong move to the upside, hanging out, consolidating right here. Do we think that it's going to bounce here and go back up? And I kind of do. So I'm going to come back, and instead of let's look at one last trade here, and we're going to look at doing something very similar to what we just did in what was that other line that we just did it in? In Costco. Silly me. But we're going to do it we're going to get bullish in UNH. We're going to join Warren Buffett and his company, Berkshire Hathaway. Not that long ago, they bought about 1.6 million worth of UNH. So let's go back, and we've been bullish on a lot of this. We did a couple of butterflies that worked out well. So now if we're going to set this up, we're going to do something similar. 20 points to there. That's 388. Delta's right there. I'm going to sell this one. A little bit less of a price stock. So 3, 4, and let's look at buying this one. 10 points away, $3. Yeah, that's about a third of the strike. You're bringing in $3.14 on a 10-point wide spread. That's about a third, right? The math is very simple. $3 is a third of $10. And you need the market to stay here. You don't have as much leeway as you would on Costco. And it's not on a percentage basis. That's not true, right? Because you have a stock that's a third of the price almost, but you do have only a smaller amount of room before we would have any risk that would kick in. But here's the trade that I would like to do in United Healthcare. We're going to go out to October. October 3rd expiration, which is 4 days away. We're going to sell the 342.50 strike put and buy the 332.50 strike put. Short-term trade just this week so that we can manage this risk and getting a solid risk reward for just a 1-week trade. And that would be our speculative play. This is the way that I would approach it. You're talking about 0 DTE and that they don't offer those in Costco. So you're looking at a Monday trade that's going to expire by Friday. You got the week. You don't have the weekend to deal with it. Yeah, I don't mind this trade at all on a shorter term basis. I wouldn't mind going out 30 plus days too, just like you did in Costco. It's an okay trade to look at it on that approach. All right. Any other questions? Here we are right at the time. So recap. We did a gold bear trade. We did a Costco bear trade. And we did a UNH bull trade. Okay. So if I look at all of these things, right, I mean, gold, I guess that's not... Gold going up would usually, there's not always a correlation, but would imply that the markets are going down and that you're nervous about the markets. So you're going to a safe haven. We're going a little bearish only because it's been frothy and market has been moving up. And so you'd think that maybe you might sell off a little bit. And that's all about a momentum play. But United Healthcare, if the markets are getting toppy, healthcare usually is one of the underlyings that a lot of people like to run to. So United Healthcare would be, I'm bullish but nervous play in the marketplace, hoping that it's going to go up, right? And that it's a safe haven also. Gold, we're just thinking it's frothy. It's had a great run up. It's about time that it comes off a little bit. And then our trade in Costco is we're just going to ride the momentum to the downside. And that's definitely a bear trade, looking at inflationary situations that are happening in the marketplace. Tariffs are hurting them a little bit. That's what they mentioned. Same store sales weren't that great. And so Costco got sold off. It's at a very big valuation relative to its peers. All right. That's it. Thanks for stopping. See you on Wednesday for the next edition of Options Guide TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.